When you think of all the wealthy people that you know or you've heard of, and try to figure out how many of those have gotten wealthy putting money in their 401k or investing in the stock market. I can tell you the answer, it's zero of them. All of them that are wealthy have built their wealth either by owning a business, owning major parts of other people's businesses, or investing in real estate.
Hello, everyone, and welcome to the Moeller Real Estate and Business Podcast. I'm your host, Phil Moeller, and on this podcast, we will be interviewing guests that have made their mark in real estate, in business, and in other areas of life. Listening to podcasts myself has helped me in so many different ways and continues to do so. If you're a real estate investor or an entrepreneur, or aspiring to be either, or just someone that wants to learn, you've come to the right place. An easy way to have an impact is to share this episode with friends or family, provide a review, or just spread the word. We greatly appreciate it, and now let's get to the show. All right, everyone. Welcome to the Moeller Real Estate and Business Podcast. I am really excited for today's guest. He is a local investor, but a passive investor, so a unique approach to investing. Jim Pfeifer lives in Dublin, Ohio. Jim was originally a financial advisor advisor back in the day, but he has shifted, and he'll talk about this, to passively investing in real estate and other asset classes as well. Jim's focus in investing is really about finding the right sponsor, someone that he knows, likes, and trusts. He's invested in over 100 passive investments, so just a very long track record in passive investing. And I'm sure he has some amazing stories and some horror stories, I would suspect. If you're investing in 100, you're not going to bat 1,000%, I don't think. So I'm sure we'll get into that. He has a finance and marketing background, University of Oregon, but then he wised up and went to the Ohio State University, local to here. So for my investors that are fellow Buckeyes, we're recording this in mid-January after that team up north just won another game. So it's a sad couple of weeks, but we'll get over it. He is a Buckeye at heart, and he also loves to ski, has 3 kids and a couple of dogs, but really just a wealth of knowledge, has really grown a nationwide brand, Left Field Investors. He has his own podcast, Left Field Investors. So Jim, welcome to the show, man. I appreciate you coming on.
Thanks, Phil. I appreciate you having me. It's a pleasure to be here.
So let's start. I'm going to ask about this whole transition of financial advisor to kind of passive investor. But before we do that, what the heck is a left field investor?
Well, it's funny because it is related to my financial advising career, because I was always into real estate as I was a financial advisor, and active and passive. And when I talk about it, the guys in the firm would always say, Jim, you're way out there in left field. And that's where the name came from. But when we look at, after the name, we thought, okay, left field investors, that's somebody who's in left field doing something a little bit different. And so when we look at left field, that's someone who's investing in alternative investments, real estate, whether active or passive. And it's just kind of, as chosen to focus on that rather than putting your money in your 401k or stock market and that kind of thing. So we look at right field as the traditional finance, and we look at left field as what I call community personal finance, which, if I can kind of go on a tangent here a little
Please
bit.
Do.
So the stock market is easy. Everyone knows how to do it. It's comfortable, and you don't have any fear about it, right? You just throw your money in your 401k and you're good, or you buy a mutual fund and you're good to go. But the returns aren't that great, right?
Correct.
And the taxes are horrible, because taxes are the biggest eroder of wealth. So that's not optimal, but it's easy. And that's why most people do it. And it's heavily advertised. That's also why most people do it. So then you go to alternatives, right? That's real estate, whether it's passive or active. It's just something different. And when you're talking about passive, it's syndications. Well, those are scary, right? Because you don't know what it is. You have to wire money to someone you might have met once on the phone. They're also hard to find. By definition, by law, some of them can't advertise, so you can't even find these investments. So they're hard to find. But the upside is the returns are generally better, and the tax situation is much better. So it's hard to invest in alternatives, and that's where community personal finance comes in, is you layer on top of alternatives a community of people that will help you. And all of a sudden, you take away some of the fear. You take away some of the, hey, I can't find these, because you're using your community to source investments. You're using your community to educate yourself. And that's where community personal finance comes in. And the way I look at it also is the stock market is speculation to me. And it took me a long time to figure this out. But you buy a stock or a piece of paper. It's now electronic, right? And the only thing you do is you hold it until you can find someone else to buy it for more than you paid for it.
Yep.
There's no current benefit. I mean, there sometimes in some stocks there's dividends, but not very often. So you're really buying for the appreciation. You're just buying and hoping that you'll get more for it later. That hope is not a strategy, right?
Yep.
Where in real estate investing, that's investing. You're buying an asset, you're having it cash flow. So there's a current benefit in the term of cash that's coming back at you. And then at the end, you can force appreciation. You can make it a better asset so you can sell it for more later. To me, that's investing. And that's when I finally figured that out, I was like, what am I doing? I'm jumping into left field and I'm ditching right field for the most part.
So a couple of tracks I want to go down. First, the return profile in general. I would talk about that for passive investments versus the stock market, the community element and just your network and the power of that in anything you do. I'm a strong believer that that's really important, and passive investing is no exception. And then it's your knowledge of investment. So let me start with the return profile. So stock market, when people think stock market, they think 8 to 10% long-term, maybe, with obviously dips and valleys and other things going on, and really a speculative, for sure, short-term strategy. But actually, I'll hit two of these now, but also, like, I don't focus on the stock market myself because I just don't know it. Now, I'm not spending a lot of time studying the stock market, but I'm interested in your perspective of first the return profile, and second, you did study the stock market, like you were in it, right? And now you're in passive investing. So talk about the return profile first, and we'll go to kind of the knowledge of your investments. What does a return profile look like for a passive investment versus the stock market?
Yeah, so you're right. Stock market, people expect 8 to 10%, right? But what does that mean? And it's very hard to figure that out, right? Because you have to take taxes out. There's fees, and there's a difference between average return where you can have an investment. So I'm trying to think on the fly here, but let's say you invest $100 and it goes up to $200, after the first year. So it's 100% return, yay. And then the next year it crashes and goes back to 100. So that's a 50% loss. That sucks. So now you have $100. Well, when you go and go to your financial advisor and you say, hey, I have $100 left, he's like, yeah, isn't that great? You had a 25% average annual return. Right. Because you doubled it. That's 100. Then you lost 50. So you're up 50% in 2 years. That's 25%.
You can play tricks with numbers.
Oh, exactly. And
right.
And so you really have to dig in and say, okay, did I really get that return? So there's a lot of things going on there, but basically, let's say you get 8 to 10% return. That's the history of the stock market.
People would be happy with that. People would be very happy with that return.
Yes, they would. But if you're going to pay tax on that. So now that return is more like 6 to 7% after tax, right? Where when you're in real estate in these passive syndications, you're expecting the cash flow. Once it starts cash flowing, you could get cash flow of 7 or 8% per year.
Yep.
Okay. You compare that to 8 to 10 of the stock market. Which would you prefer? I'm going to take 7 or 8 every day because I'm not paying tax on it if I do it right. And we can talk about that, but you don't pay tax on real estate generally if you set it up correctly.
Yep.
So now I'm comparing 7 or 8% tax-free to 5 to 7% after tax, or 6 or 7, whatever you get from the stock market. But also the other benefit of real estate is that it's a slower market, right? So let's say I invest in Apple stock and they kill it and they have this new great thing they invent, whatever it is. And it's just the best year Apple's ever had. Well, if they do that in the same year that the stock market crashes, their stock is going to crash too. Maybe not as much as everybody else, but their stock's going down. And I can't call up Tim Cook, the CEO, and say, hey, Tim, tell me what happened here. Right. So it's totally out of your control. Now, syndications are out of your control also, but just because the real estate market, I put that in air quotes, melts down, that doesn't mean your asset in, Columbus, Ohio, that multifamily asset is not going to perform. Right. And it certainly isn't going to crater the next day.
Yep. And there's a real asset there. There's a real product, there's a real asset behind this investment. Yep.
and I can call up the operator and say, hey, Phil, what's going on with this? And I'm pretty sure, Phil, you're going to call me back, right? You're not going to be like Tim Cook and ghost me. So there are a lot of advantages to being in the left field, as we say, and investing in real estate over the stock market. And those are just a few things that I look at.
And the other element of passive investments a lot of time is you're getting that 7, 8, 9% distribution. And a lot of times in real estate that will grow. So maybe year 1 is 6, but year 2 is 7, year 3 is 8%. And there's growth of your cash on cash return. That's also just, and then you talked about the tax benefits, but those are only 2 elements of this, because you have an asset that is generally growing in value. And a lot of times a syndication, there'll be a 5-year plan. Maybe that's 3 years sometimes if it goes well. Maybe it extends to 7 or 8 years sometimes, but your asset should be growing in value. So your total return, a lot of times, the projections on all of these investments is in the 13 to 15% internal rate of return, which I think is a great metric in comparison to the stock market. Would you agree with that?
Absolutely. Yeah. And that's, I didn't talk about it, but that's the appreciation, right? And the difference between appreciation in the stock market and appreciation on a multifamily asset is that in the stock market, they're trying to grow, but it's not based on the income of the stock necessarily. It's a lot of it is just based on market sentiment, investor sentiment. This is a good time in the market, so everything goes up, right? Where in real estate, if you get a quality operator and they're forcing appreciation, right, and the market values the property based on net operating income. So if they can increase the net operating income, they increase the value of the property. And so you're getting both. You're getting appreciation and cash flow. Now, I focus on cash flow because I don't have a W-2 income. And so cash flow is the most important to me. But yeah, when I was talking about that 7, 8%, I'm talking about the cash in your pocket today. And you're talking about the other great thing is you can expect another, 7, 8% on the back end in the form of appreciation. And so that's where, and again, the kicker is the taxes, right? You're not paying tax on any of this if you do it right. Talk to your tax advisor. I am not a financial advisor or a tax advisor. Just a little comment there. But the upside is really what would get you, and avoiding paying tax is really what helps you out.
And there's a lot of strategies. And when it first of all, I think investing for cash flow is a great concept no matter what, because quite frankly, if a product or an asset has cash flow and that cash flow is growing, that probably means the NOI is growing, which means the value of the business or the asset itself is growing as well. So a great strategy. And I think the other element of that is when you're working with someone, having the right structure of debt. So you actually, in real estate, you talked about the market and not having, you can time the market sometimes. So if, 4 years from now, the market interest rates are way down and it's a great time to sell, your sponsor could sell if that's their strategy. Or if it's not a good time to sell at that time, they can say, hey, let's just hold this for 2 more years if they have a good debt structure in place. So the sponsor has a lot of flexibility within the broader market to kind of influence your returns.
Yeah. And they can also, if the market is ripe for it, they can refinance, right? And then if let's say they buy the building for 10 million and then they force equity and they increase the value to 15 million, well, they can refinance, and that difference, that extra 5 million in equity, they can return that, and they can return capital to you. And again, that's not taxable because that's just giving you your capital back.
And we are not CPAs here, but there is a lot of tax strategy around all this. In a refinance event, which is a great event, you get your capital back. Maybe it's 50%, 75, sometimes 100%, zero taxes paid on that capital event because it's not an income event, it's a capital event. And then you can go invest that elsewhere too and just kind of compound the returns.
Yeah, and the current asset, you're still an owner of that asset, even though your capital has been returned. So if you do the math on that, that's what's called infinite returns, right? Because you can't divide by zero. So that's just, you've totally de-risked the investment. Every single dollar you get out of it now is just gravy. So and that's like the one of the many holy grails of real estate investing is when you get into the infinite returns.
Well, so Jim, I want to shift gears a little bit. So you're talking about, you were a financial advisor. So I would say, in the world of investing, you were pretty darn knowledgeable out of the gate. And then you've been in this world of passive investing or investing from left field. Who should look into this? I mean, a lot of our society, quite frankly, is in right field. They're investing what you called traditionally. who should be a left field investor or who should be a passive investor in syndications?
I mean, I'm biased clearly, but I think everyone, I don't see a reason not to do it. Now, do you have to go all in? No. I think if you would have asked me 2 years ago, should anybody be in the stock market at all? I would have said no. But there are some reasons, right? I've dipped my toe back in, but just for liquidity, right? There's a bunch of places I get liquidity. I have a whole life insurance policy that I do the infinite banking. So I think that's a phenomenal place to store some easy liquidity, but also that has a cap on the upside, right? It's not an investment. It's a strategy, it's protection, but it does provide me with cash. So if I want to have some extra cash that I want to hold for opportunities later, I don't want to just sit it in the bank. Now, a couple of years ago, I would have said it 0%. Maybe now I can get 3 or 4, maybe even 5, but I might put a chunk of it in the market because then I can take it out whenever I want, but it has an upside. It also has a downside. Yeah. So there is some reason to be in the market, but generally, like we keep saying, like taxes, that's the biggest destroyer of wealth. Well, so what I would say, if you're a W-2 employee, it's really hard to not pay taxes. But if you can shift some of your after-tax money into these real estate buckets, right? Then that money, once you put it in there, it's never going to be taxed again.
Yes.
So even if you get the same or even less return than you would from the market, you're still winning. Now, most people are shoving money in their 401k, right? Why are they doing that? Easy, safe, again, with question or quotation marks.
For sure.
And everyone is doing it. But what are you doing? You're deferring taxes. That sounds great, right? Defer taxes to pay it later. Well, where do you think tax rates are going to be in the future? Right? Do you think they're going to be higher or lower? I would say, if you look historically, taxes are, believe it or not, at pretty historic lows. And if you look at the debt of the country, right, that's at historic highs. So where's the government going to go to get money? They are going to raise taxes. So what you're doing now is you're saying, okay, government, I'm going to not pay tax today so I can pay it later when it's a higher tax rate and after my wealth has grown. So, I'm going to... And that's just, it's backwards thinking, but the government thanks you. And actually, I thank you too, because then you're going to be paying more tax in the future. Well, I'm not gonna. Right. So that's great.
And honestly, for all the listeners, a lot of people don't think about this, but their single biggest expense they're paying every single month and every single year is for sure taxes. You have to have some really massive other expenses for taxes not to be probably your single biggest expense. Yet so few people build a strategy around how do we reduce that. Now, what you're talking about is you still may continue to pay the same income taxes, but if you invest passively in real estate, you can manage that entire bucket kind of separately and grow that wealth, generally speaking, tax-free over the long term.
Right. And there are exceptions, right? You said that most people, the biggest expense is taxes. It's not my biggest expense. Correct. I'm embarrassed sometimes to say how little I pay in tax, but I'm following the tax code. Tom Wheelwright, a very well-known tax CPA, says that the tax code is an incentive structure, right? It's the government telling you, here's what you do. If you want to pay high taxes, go work a W-2. If you don't, go do these things. And some of these things are real estate. And so that's, that it's just following the tax code.
Tax-Free Wealth by Tom Wheelwright is the book that Jim's referencing, a great book for our listeners. So how can what does it take to be successful? So we have these listeners here. Some of this is brand new to some of our listeners. Some of them are familiar with passive investments, but man, it just seems overwhelming. Where do I start? What does it take to be a successful passive investor?
Well, this is going to sound self-serving, but I don't think you can be successful as a passive investor unless you're part of a community or a network. And it doesn't have to be left field investors. Yes, I'm biased. I think ours is the best community out there, but there's plenty of different communities. I would recommend joining several. Find one that the culture of that community fits your personality. And you will be surprised how quickly you can build that little snowball, that little nest egg and get it growing. But you really need some expertise. And I can give you a few examples, right? When I first started, I didn't know what I was doing, right? And so I went to a seminar and I was really nervous about it because I was actually spending money, to fly to a different city and go to this seminar. And I didn't know if it was legit or not, but I just said, you know what, if I'm going to be in real estate, I'm going for it. And this is when I was still an active real estate investor. And I got there was they were teaching about syndications. And it's, 5 minutes in, I thought, you know what? I don't want to be a syndicator. I want to be a passive investor. And so I figured that everybody there, all the operators there, must be fantastic. They must really know what they're doing because they were invited to this seminar.
Yep.
Well, I didn't understand that they paid to go to the seminar, and probably
Right.
paid more than me because they were going to find people like me.
Yep.
But anyway, I went and I thought, I'm going to get into this. And I just started walking up to operators and saying, oh, hey, you're an operator. How do I invest with you? Here's a check here, and just handing out money, right, to these investments. And that was a really poor way of evaluating an operator and an asset, right? And so after that, I learned, okay, some of those turned out okay, some did not. And I figured, okay, I got to find a better way to find operators. So after that, I started listening to podcasts, reading books, and I'd listen to a podcast. I'd hear an operator. I'd call them up, talk to them for 30 minutes and evaluate them, right? And this was a much better way of doing it. But still, I didn't know, is this a great marketer or is this a great operator?
Yep.
They could be both. They could be one or the other, or they could be neither. I have no idea. I'm talking to them for 30 minutes. They send me a deal, and then I'm expected to wire them $50,000. Terrifying, right?
Yep.
Still, a better process than what I was doing before.
Yep.
And the reason I'm explaining this is because now we come to how do you become successful at picking operators? That's where community comes in, right? Now, I will not invest with an operator that's new to me unless they were introduced to me by someone in my community who I know, like, and trust, who's already invested with them. That doesn't mean the deal has to have gone full cycle. It just means they've invested with them. They've wired the money and it's actually landed somewhere.
Yep.
They've gotten some reports. Maybe they've gotten some distributions, and they're happy with that operator. Then I will start my due diligence process and do the same due diligence I did before, but I'm starting, 100 steps ahead because I already have confirmation from someone in my community that they're a good operator.
And honestly, it's such a, just first of all, in general, who you network with, who you're connected with, like building a team, building a community is so important. No matter what you want to be successful in my opinion, if you want to be an active investor, passive investor, you want to get more healthy, whatever it is, having a network can accelerate your success so you can skip steps along the way. The other thing is there are very clearly, just like there are good and bad stock investments, there are good and bad real estate syndication investments and sponsors. So bet on the jockey, not the horse, is really, really important here. And knowing who you're investing with. Anyone that has an Excel sheet can create any story they want. Any really good marketing person can tell a great story, but having a referral or a connection from someone that has worked with them directly, I think, is so valuable and great insights.
It is. And just to be clear, it does not prevent you from losing money. It does not prevent you with hooking up with an operator who goes sideways. I mean, we had one of the favorite operators in our community really just fell flat and messed up on a bunch of different investments. And we were all surprised. And one of the things we looked at is, okay, what can we do next time so that we find this out? Because they checked all the boxes. They were experienced. They had a great track record. They were referred to us by, different people that we know, like, and trust, but their deals still failed. So what do we learn from that? Part of it is diversification, right? Don't go all in with one sponsor or one asset class or one market. And really, also don't go all in on one strategy, right? If they're an apartment flipper, then find somebody who's an apartment long-term hold, right? And balance things out. So there's lots of things you can do, but none of this is foolproof. These are long-term illiquid investments that are completely out of your control.
Right.
So,
and my opinion on that is there's good and bad. And if you're on your own, you're going to depending on your level of experience, you might be 50-50 good and bad. Who knows? I don't know what that number is. So maybe I shouldn't say no, but if you're with a community and with a community where the person kind of running the ship has invested in 100 deals, some good, some bad, and then the board or the founders collectively have probably invested in a couple of 100 deals, you're now leveraging that collective knowledge. You're not going to bat 100% by doing that, but you're going to be way better off than if you do this on your own.
Yeah, exactly. And that's why I think, that's why I'm always out here saying community is the number one most important thing to success as a passive investor. It really, really is.
Is that what, what made you want to create? So let's talk about left field a little bit more. I mean, you've referenced it, the importance of community network. I talk about that a lot. Just you become with whom you associate. There's all kinds of words and phrases around the power of your network. Again, in my opinion, in all areas of life. So how did this start? Like, what made you? What was the mindset shift or whatever it was where you said, I'm not going to do this on my own anymore, or from the beginning, I'm not going to do this on my own at all? When was that transition? What did that look like?
Yeah, well, I wish I could jump up here and say, "Oh man, this was totally intentional. I just nailed it." But it wasn't. It was an accident. So, in when I was an active investor in real estate, I started a group called the Central Ohio Investor Network Coin, and it's still going in Columbus. I'm not active in it anymore, but I got so much out of it. And the reason I started it is because I just wanted to talk to other people who are doing active real estate, and I couldn't find a good community. And so we started that, and I met a bunch of people and I did business with them. And it was just a great way to learn. And so then when I changed over and decided, hey, I'm just going to do passive stuff, I thought, I want to start just a little mastermind. So I started a 12-person dinner club in Columbus, Ohio. And then I realized there were so many people interested in learning how to do this that we just opened it up and allowed people to join. And so every kind of step of the way, we eventually we built a business, which again was not intentional, but now we have about 2,000 members. We have a very active forum where people post content, ask questions, answer questions. We have webinars, and we had a couple of meetups in Columbus where we got together in person, and we're doing a meetup at the Best Ever Conference this year, which is the premier kind of syndication conference, and we're getting a full day of limited partner education there. So we didn't really build this intentionally, but it's helped me become a better investor for sure. I've gotten more out of this community than anyone else, just as far as education for me, right? And then sharing it with others is part of what I like to do as well.
I'm kind of curious. This is just a tangent, but have you gotten other benefits outside of investing, just passive investing from this group? I mean, you got a group of guys who kind of want to be purposeful about investing, but has it gone out into other areas of life? Or is it just focused on investing?
Oh, it's mostly investing, but it's also people, right? I've met so many great people, and as you're learning as you start your podcast, the biggest beneficiary of that is you, because you're going to get to talk to all kinds of just amazing people, right? And that's it for the podcast. I mean, I've talked to just all kinds of great people, learned from them. I've become friends with some of them, and so it's really about, I think you mentioned it, finding like-minded people, whether you're talking about investing or family or health or whatever. Just building a community, it goes beyond just investing for sure. And most of the benefit I've got has been education and learning how to become a better investor, for sure. But I've also gotten some fantastic relationships, not just with the other founders of LFI, but also with our membership.
Yeah, that's amazing. That's amazing. Well, I want to, this has been great. And I think just it's given such a good perspective of, anyone can be a passive investor. It's just the benefits of real estate and passive investing, but also it's not easy. There's got to be some effort put in just to learn it. And the best way to accelerate that is with community. So I appreciate all the insights. Jim, tell me, in general, factors of success. So if I were to say, Jim, what are some key factors of success? What would you tell my audience?
Well, again, broken record. Hello, community. I would not have success without the group of people and the culture that I say we built, but it wasn't me. It was the people that joined our community that built this culture. So that's the number one factor of success. And then, just to be plain and honest, if you're going to be a passive investor in real estate, you also need starting capital, right? So it's sometimes a struggle for new people, but there are ways around that. One factor of success, you said I'm in 100 plus syndications. That is true, but a lot of those are through a company we call TribeVest, which is it's a platform that helps us invest in groups. And what this does, so let's say I have $50,000 to invest this year in syndications. Well, that's one deal, right? And I'm done. But if I team up with 4 other people and they all have $50,000, now we can get into 5 deals, and I'm only 10 grand into each. But that just expanded everything. So that's another factor of my success. It allows me to diversify. It also puts me in a club, right, of people that have the same interests as I do, a kind of a subgroup of our community. And when I bring them a deal, they're going to push back. Right? Why this? What about that? And so then I'm going to learn and become a better investor, as are they. So then you create these little mastermind groups as well.
Yep.
And so that's been another factor in the success. And then I think another thing to think about is just patience, right? These are long-term deals, illiquid, out of your control. This is not a get rich quick scheme. This is a build wealth slowly scheme. But you will learn that your snowball starts small, and you will be shocked at how fast it grows until it's big and meaningful, right? And
Yep.
so I think patience is another key factor, because especially over the last few years, it was so easy to make money in real estate, and people got, impatient. And
Yep.
so one of the guys that came on the podcast, he talked about, instead of FOMO, you should have JOMO, which
Oh,
is
boy.
the joy of missing out.
Oh, yeah.
So I've tried to take that and be like, okay, I don't have to jump into this deal just because, hey, it's going to be gone tomorrow. Okay, there's a new one coming the next day. So the joy of missing out is watching yourself just step back and say, I don't need to jump into every deal. New ones will come along, and only pick the ones that I'm comfortable with. And don't, you don't need to take a bunch of flyers. There's a place in your portfolio for taking outsized risk where you will get outsized return, but that's a small place.
Yep.
And that's, not to do passive investing probably with that generally.
Yeah. Jim, I needed that more than the JOMO comment, because I'm investing in real estate and I'm looking for deals for the last year and a half. And I'm just saying they just, a lot of deals don't make sense. And I'm not saying none do, but a lot of them
Right.
don't. Actually, the other benefit of passive investing is if you have capital to invest and you're an active investor and you can't find deals, you can also evaluate passive investments to invest in and choose to just diversify into that or invest in those, ensuring those are good deals. But now you're leveraging other people's ability to find those good deals, not just your own.
True. Yeah. Great point.
So what is the portfolio like at a high level? You mentioned diversification a couple of different times. You mentioned kind of the asymmetric risk or asymmetric bets investments. At a high level, like what guidance would you have for people to how should they think about this?
Yeah, I think, you want to invest in, I think it was Peter Lynch said, you want to invest in what you know, right? And so everyone's lived somewhere. So real estate, that makes it easy, right? Multifamily, if that's comfortable. So, and then there's a ton of other asset classes too, right? There's self-storage, there's mobile homes, there's, now there's car washes, there's RV parks, there's laundry, there's just a ton of different things. So what I try to do is definitely diversify by asset class, by market, by operator, by debt type, all of that. So, the bulk of my portfolio is in real estate. I have, 5 to 10% set aside for speculative stuff like Bitcoin or angel investing and things like that, most of that money is going to go to zero, but hopefully I'll get a couple that really pop off and balance things out. I have a small bit in the market still, mostly in my old, retirement accounts. But I think the key to, kind of figuring out where your portfolio is be in multiple asset classes, but make sure you're not just investing in an asset class because you got to check a box. You need to find a good operator with a good deal in a good market, and then you can go into that other asset class. So it's really hard. It's not like, financial advisor says, oh, you got to be in 60% stocks, 40% bonds. You're not going to get a number like that for real estate. So it's really just each person's different.
And honestly, I think I primarily invest in multifamily as an operator, but my passive investments are in many different asset classes. But people have options on how to diversify. So if someone's like, I know multifamily, that's all I want to invest in. You just named you can invest with different sponsors in multifamily. You can invest in different markets in multifamily, different debt structures, different return profiles, shorter term versus longer term. So within an asset class, I would support investing in different asset classes as well. But if you're really comfortable with one sponsor or whatever it might be, you can diversify in there's a lot of different dimensions to this.
There's a lot of ways to diversify, but I would also say that, even if you're just comfortable in multifamily, I would branch out and maybe look at a mobile home park, right? Yep. Or as somebody said to me today, the difference between multifamily and self-storage is just the tenant, right? The tenant in multifamily is a person. The tenant in self-storage is some stuff, but it's really just a box that it has something in it. So I would encourage someone to really branch out. The only time I think you should really focus is when you have some kind of expertise that gives you an edge,
Yeah.
right?
I like
If you know a market, like Columbus, Ohio, and the south side of town, and there's a neighborhood there that you just know everything about, and all the real estate, then yeah, focus, go dig in there and buy it all up, and you'll crush it, right? But if you don't have the knowledge, if you don't have any specialty knowledge, because that's what passive investing is, right? I can't go and buy a self-storage facility or a multifamily home and have success. In fact, I know that I had a multifamily home and I was terrible at it. The
Yep.
only thing that saved me was the market. I was a bad asset manager. That's why I do passive, because I'm better at evaluating other people than having the expertise myself. So
Yep.
unless you have hyper-focused expertise, I say you hire asset managers who have the expertise,
Right.
and then diversify amongst them.
I like that. And quite frankly, a lot of the principles in multifamily and mobile home parks and self-storage are generally the same philosophies. One of the best investments I'm in as an LP is a mobile home park, quite frankly. So just providing great cash on cash returns and adding value. So good stuff. I want to continue the shift here a little bit. I wanted to hit the diversification and JOMO question, because the JOMO is just too good. I couldn't avoid it, Jim. So I like that. But how do you educate yourself? You kind of referenced some things earlier, but what's your primary source of education outside of your community? Because I know that's a big one you talked about, and I'll come back to that.
Yeah, I think it's just having your eyes open. I try to follow what's going on in the world, but I have two podcasts that I do, Passive Investing from Left Field, and then I'm also a guest host on Whitney Sewell's the real estate syndication show. And just learning from people like that. Now, I know everybody can't start a podcast and learn from those people, but you can listen to those podcasts because they get interesting guests. So I listen to a ton of podcasts. That's how I start every day as I go for a long walk. And I listen to podcasts, and I listen to some real estate ones, and then I listen to something that's going to entertain me. You mentioned Ohio State football. I'm a big fan. So, it's kind of hard to listen to them now, but that is something I like to do. So I think, you have to have balance in life.
Agreed.
And all of that.
Agreed.
But yeah, I get most of my knowledge from the community, but podcast is probably second.
Is there a favorite podcast you're listening to right now, that just on real estate or whatever it might be, that you would maybe point people towards? Again, so Left Field Investors Podcast, for sure, everyone needs to listen to that. But in addition to listening to you don't have to listen to those, because you're doing the interview directly. And maybe I don't want to listen to myself.
No, I hate listening to myself. But Drunk Real Estate is a weird name, but it's a good podcast. It's Jay Scott, who's a member of our community, and then Mauricio Rual, who's a very well-known syndication lawyer, and then I think it's AJ Osborne and Kyle. I forget Kyle's gonna kill me. I forget his name. But they're just four guys, and they call it Drunk Real Estate because they sit around and have a drink while they are talking about real estate. But they really focus on the economics of it, and they're really smart guys, and it's a really great listen. Another one that I like to listen to is what is it called? Invest Like a Billionaire, I think is it called. And that's again from another operator, Aspen Funds, but Bob Fraser and Ben Fraser, and they both, again, they focus on economics and how that interplays with real estate. So I really enjoy both of those.
And I think that last title, just Invest Like a Billionaire, puts context to the day and age that we're in, where information is so accessible, and you can get into the minds of people that have been really, really successful. Quite frankly, anyone can launch a podcast. So be aware of who you're listening to.
Yeah.
If they've listened this far, Jim, they're liking this episode, so that's good. But be aware of it. But there's just so much information out there that can propel you from where you are to where you want to be. And there's someone that's probably done that, maybe in a different path, but has gotten to where you want to be. So good stuff. Last question, kind of on network. So who is a specific person that you can think of that has had a really significant impact on you?
I think that's a tough one, because I think lately it would be kind of the other founders of Left Field Investors, because we spend so much time together building this business, and they're all just, hardworking guys. Unfortunately, we're just a community, so we can't really compensate them or give them the value that they deserve for the work that they put in. But each one of those guys has had a tremendous effect on me, my investing, and personally.
Yeah.
So there's 6 founders of LFI. I'm included. And they're just fantastic guys. So I think they've had a huge influence on me over the past 4 years, 100%.
Awesome. Awesome. Again, I think it just speaks to the power of your network and your connections in your community. So good stuff, Jim. Anything else you want to add for the community? Anything I missed that you would want to talk about just for our listeners?
I think if you're not in real estate and you're thinking about it and you're like, well, I don't know, think about all the wealthy people that you know, right? And we're not building wealth just to be, Scrooge McDuck and throwing cash around, but we're building it for financial freedom, right? So you can make your W-2 optional if you want to, or you can have time freedom, you can have place freedom, you can have all these different kinds of freedoms because money isn't stopping you from doing things. But when you think of all the wealthy people that you know or you've heard of, and try to figure out how many of those have gotten wealthy putting money in their 401k or investing in the stock market, I can tell you the answer. It's 0 of them. All of them that are wealthy have built their wealth either by owning a business, owning major parts of other people's businesses, or investing in real estate, right? There are very few people who have all of their wealth from working a W-2 and throwing money in the market. So if you want financial freedom, true financial freedom, you got to do something different. And the different is if you don't want to run your own business, then real estate might be it for you.
I love it. That is amazing. And just words of wisdom. And quite frankly, it's hard to deny. Like, you can say that, but I would challenge all of our listeners just to write down 5 or 10 people that they're aware of that has wealth, and what has that person done? How have they gotten there? And it's a business or it's real estate, one of the two. So I love that. Well, Jim, I think we could talk for another hour. I wanted to go in a lot of different tangents here. I avoided most of them, but I went down some of them. The JOMO will stick with me forever, so I appreciate that. How can people find out more about you or Left Field Investors, or where do you want to point people?
Yeah, you can go to leftfieldinvestors.com. There's a bunch of stuff there. There's a button to click if you want to schedule a call with one of the founders. There's a bunch of free resources on there. There's also a membership. It's $199 a year if you want to join. Then you get access to the forum and our deal flow and things like that. You can also reach out to me personally. My email address is jim@leftfieldinvestors.com. Feel free to reach out. I schedule calls all the time with new investors if they're interested in just chatting and learning more about Left Field Investors or how we operate. Always happy to do that.
Awesome. And I'll just say that when I'm a member of Left Field Investors, the infielder community. I went to the event last year. I had a conflict this year. Great event, close to home for anyone that's in Midwest Ohio or Columbus, especially. And I just know Jim was so welcoming, so volunteering of his time to help me as I was getting started at the time in passive investing. So I appreciate that personally, Jim. And I know that when he's saying that to my audience, that's sincere. He means that. So check them out. Jim, I really appreciate it. For all of our listeners, we appreciate it greatly. This is the Moeller Real Estate and Business Podcast, signing off. Thank you for listening to the Moeller Real Estate and Business Podcast. We hope you found today's episode helpful. If you know current or aspiring investors or entrepreneurs or anyone that would benefit from today's episode, we appreciate you sharing it with them, or better yet, providing us a 5-star review. To learn more about Moeller Real Estate, visit our website at www.moellerre.com. You can also sign up for our newsletter or local events via our website. In closing, I encourage you to be purposeful in all areas of life, educate yourself, network with others that have been successful, take action, and lead. Thank you.